Hi everyone, welcome to the June 2023 investment update. My name is Matthew Leong, I'm portfolio manager, and I've got with me Graham Bibby, who's our chief investment officer. So Graham, to start off the year, bonds have been pretty solid. Equities, on the other hand, have had a very, very good start to the year, obviously led by US tech and, for example, NVIDIA leveraging the AI theme that has been getting a bit of hype of late. NVIDIA is up nearly 200% year to date. So in terms of our outlook and our positioning, right now we remain fairly cautious. We remain underweight risk and growth assets. Graham, would you mind talking to some of the high-level macro reasons as to why we're positioned so conservatively?
Yeah, definitely. So we have a framework for looking at underlying economies and markets and how they play through to the asset allocation that we put forward. So in the underlying markets, we see the drivers being fundamental factors from the economy, liquidity that also comes out of that, fundamental valuation and sentiment factors. So the underlying economies have been slowing. We've seen a previous build-up in the economic momentum that was quite positive up until March, and then since then we've seen a decline in some of the economic indicators. So that's indicating a slowing of momentum in the economy, and it's becoming self-fulfilling in a way as we see this recession narrative build. Looking through that to the underlying liquidity, so we've seen liquidity in terms of money in the system continuing to drain out. A combination of banks tightening their credit standards and also people allocating away from their savings into the expenses, and that includes businesses as well as households. Valuations have been quite high as a result that previous momentum running up into end of March, and we've seen that exacerbated as Matt said, amongst a narrow range of stocks. However, we've seen the positioning and the sentiment quite mixed, and in fact, in institutional investors, it's very negative. We do see some positives on the positioning with retail investors allocating more into equities, but on balance, it's quite neutral to negative, and overall, that gives us pause for concern around where the equity markets in particular and bond markets will go to from here.
Yeah, thanks Graham. That's a good summary of our views. So with the challenged outlook, how can investors these days access differentiated sources of returns?
Well, one way to do that is to look outside of public markets. So we see opportunities in private markets for less volatile opportunities, and particularly where people are moving away from banks, businesses aren't able to get the same credit that they can get from banks. There's actually opportunities in non-bank lending, and there's opportunities in asset classes that are repricing due to interest rates.
So we do have a partners private offering that's a no advice wholesale only offering, where we leverage our collective experience, our networks and our research capability in order to find attractive opportunities. What are some examples of interesting deals that we've seen lately?
There'll be things that are quite niche and very hard to come by, such as Melbourne Airport, which is an opportunity that we arrived at through Dexus. We were aware that some super funds were rebalancing because of that negative view, and some opportunity became available to access that as a private investor. So we raised for that recently, and that's got a pretty interesting outlook given that passenger numbers and use of the airport will continue to grow. We've seen other opportunities in industrial property and in some debt co-investments, again leveraging off the some of the areas of the non-bank sector that are doing well.
Yeah, thanks a lot for that. So that's some pretty interesting opportunities that we're seeing out there. So if you are a licensed wholesale investor, please do reach out and contact our team for further information. That's it from us for this update. Thanks a lot.